Okay, so I want to pick up on part 5 now, and I'm going to scroll down, and they give you a nice bunch of examples here, like Whirlpool and the average collection period for different industries, right? And Sears and Best Buy, and all right. So the next one is the average payment period, and as I said, that's how long it takes you to pay your bills to your creditors. Maybe you're late on your mortgage and it takes longer, and that's equal to the accounts payable, right? Divided by the average purchases per day. And again, you take your purchases. Now, the problem is you're not going to find this on any statement. You kind of have to know your purchases, right? So obviously this is not going to appear. And again, it's daily. So you can see they make an important point here. They say the difficulty in calculating this ratio stems from the need to find annual purchases not available in financial statements. Okay. Ordinarily, purchases are estimated at a given period, a percentage of cost of goods sold, and in this case, they use 70%. Okay, so they plug in, and you can see that it's about the same, the average payment period. So they pay for their purchases in about 15 days or so. All right. All right. Total asset turnover now is a measure of the efficiency with which the firm uses its assets to generate sales. Okay, so just to give you a simple example of that, some people have flea markets, right? They run flea markets, and they buy some product, and maybe at home you make some kind of widget, and you've got some tools home, right, to make the widgets with, and those are your assets, right? You bought these tools. And basically, you're making a lot of product at the flea market and selling them like crazy. So basically, you may have paid $300 for these tools, and you're making a ton of money on the product. So you can see it was worth buying those tools, right? How many dollars of sales a firm produces for each dollar of assets that it has invested in the business? So again, this is an important point, and that's why I just gave you an example of kind of, right? So that's divided by sales, which comes off of the income statement, and total assets, which comes off of the balance sheet. Okay, so again, they have a little nice box here to talk to you about. And you can clearly see here, the total asset turnover got a little worse, and it slowed a bit in 2016. And that would concern managers if it was part of a long-term trend, right? So if you start seeing a trend where this is going down as it is here, you might get a little nervous, right? All right. So again, there's review questions here. You should try to go over them. Make sure you understand everything. All right, my colleagues. So let us go over now what's called debt ratios. And the debt position of a firm indicates the amount of money the firm uses that does not come from shareholders, but rather from other lenders. Let's say bonds, right? Short and long-term bonds, or banks, right? And why don't we make that a nice blue? All right. In general, analysts center most on long-term debt that commit the firm to a stream of contractual interest payments, right? It should be contractual interest payments to the bondholders, right? Over many years. Okay. The greater the debt, the greater is the firm's risk of being unable to meet its contractual debt obligations. So in general, and there's an important term here called financial leverage, the magnification of risk and return through the use of fixed cost financing such as debt and preferred stock. So in general, the more debt a firm uses in relation to its total assets, the greater is its financial leverage. So greater debt means greater financial leverage. Right, so there's a nice example here for Patty Akers, and she's going through her business, right? And here's her balance sheet, right? I don't know if can I highlight that? Yes, I can. There's her balance sheet. And here is her income statement, right? Make that pink, right? And here's her return on equity, right? For each year. And so you can clearly see how return on equity is 33.2%. So the previous example demonstrates that with increased debt, greater risk as well. So with increased debt, this is very important, comes greater risk as well as higher potential return. Okay? Therefore, the greater the financial leverage, and this is real important, right? The greater the potential risk and return. All right. So later on, there's going to be a whole chapter, but I don't think we'll get to that. I think, so. Okay, so basically, all right, so there's going to be two types of leverage here, right? There's two general types, measures of the degree of indebtedness and measures of the ability to repay debts. So you can see they talk about one here and they talk about the other one right here. And these ratios are also called coverage ratios. So these ratios, and they help analysts assess whether a company can service their debts, make payments on time. So if you have a car loan, right, and a mortgage, the bank wants to make sure you make enough money to have enough liquidity to cover your debts, right? All right, so let's go over the debt ratios here, right? So the first debt ratio, so this debt ratio is total liabilities divided by total assets. And these come off of the balance sheet, right? These come off of the balance sheet. And you can see that for 2016, it's much higher than 2015. So this value indicates that the company has financed close to half of its assets with debt as of 2016. And the company dramatically increased its debt ratio that year. Okay. So, that could be a problem if it's long term. So they watch that, the analysts. All right. So the debt to equity ratio measures the relative proportion of total liabilities to common stock equity used to finance the firm's assets. So here's the equation. Total liabilities divided by common stock. Now remember, it's common stock equity, not preferred. So make sure you understand where these numbers come from, right? Total liabilities divided by common stock equity. And both of these come off of the balance sheet, of course. You should know that. So the result, what does the result say? That for every dollar in common stock holders have invested in Whole Foods, the company owes about 97 cents to creditors, right? So the shift in the company, you can see there's a shift in the company's financing mix away from equity to debt. And that's an important statement that's being made here. Okay. So, of note, several methods exist for calculating the debt to equity ratio. A common alternative uses only long-term debt in the numerator. In that case, the ratios for Whole Foods are, so this only looks at long-term debt. Okay. So it's done in several different ways. All right. All right, so the next one now is times interest earn ratio. And this is earnings before interest and taxes. And this comes off of the income statement. And this interest they're talking about is the interest on the debt that you're paying to the bondholders. All right. So the figure for earning before interest and taxes, and another name for EBIT, is operating profits. Okay. So this is an important statement. You kind of have to know that they use different terminology sometimes. So the income statement for Whole Foods shows interest expense of 0, So we cannot use equation 3.9. So the times interest earned ratio in 2016 is 800 his EBIT, right? And here is the interest on the debt, right? Okay, so that's pretty straightforward. And now you have to analyze it, though. The math is easy, but then you have to analyze it. All right, so the fixed payment coverage ratio measures the firm's ability to meet all fixed payment obligations, such as loan interest and principal, lease payments, and preferred stock dividends. So here, this one's got a couple of different terms, all right? So it's earnings before EBIT from the income statement, lease payments from the balance sheet, interest on the debt from the income statement. Again, here's lease payments again, plus principal payments on the debt, plus the preferred stock dividends. All this is times 1 divided by 1 minus the corporate tax rate. Okay, so this is a little difficult, but you can try plugging into that and doing that. Okay. So basically, what happened is before they only gave, because they only gave you the abbreviated financial statements, you can't do this calculation. I wouldn't worry too much about this equation. All right, this just is a little cumbersome, so please don't worry too much about it. Okay, so let us. All right, so let's look at the profitability ratios now. And there are many measures of profitability, and this is going to tell you how much money you're making, okay? And one of the methods used is called a common size income statement here. And I'm going to highlight that. And if it lets me, okay. So common size income statements provide especially useful when comparing performance across years because it is easy to see if certain categories of expenses are trending up and down. Okay. And and this is important, 3 frequently cited ratios of profitability that come directly from the common size statements are gross profit margin, the operating profit margin, and the net profit margin. Okay? Let's highlight that. Okay, so now here's how they do the common size income statements. And they're taking all the numbers on the regular income statement. Okay, here's your income statement, but you notice now it's in percentages, right? It's in percentages. And I'm trying to highlight this. And what they do is they take all the numbers and just divide all the numbers in the regular income statement by the sales. So you can see sales divided by sales would be 1. And the cost of goods sold divided by sales, you would see you would get a fraction, so 65.6. So what they're doing is they're making everything a percentage. Okay, see how everything's being made a percentage? And then they could basically do a comparison based on the percentage as they do the evaluation here. Let's see if I could highlight that. Okay, so it's important to see what they're doing here. Okay, and you'll notice that the cost of goods sold went up. You see in 2016 how it went up? So things have gotten worse. The gross profit margin, you notice how it's gone down in 2016? So things have gotten worse. And now the selling and general and administrative expenses have gone down. See this here compared to that? So it's gotten better. So see what they're doing? It's going to be worse, better, or the same. Okay. So that they're just taking everything as a percentage. Any questions about what's going on there? Just let me know. All right. So the next set of ratios is the gross profit margin, And the gross profit margin measures the percentage of each sale dollar remaining after the firm has paid for its cost of goods sold. All right, so let's see if they, so here's the, I'll just, you can read this, and let's jump right to the ratio. The gross profit margin is simple, right? Sales minus cost of goods sold over sales, and that's all from the income statement, right? So that's called gross profit. This is called gross profit here, right? It's the same thing over sales. And it basically tells you how much gross profit you're making here, okay? Obviously, the best this could be is 100%, right? All right, so. All right, so the operating profit margin now is going to be the operating profits divided by sales. And you could basically see from the income statement, this comes off of the income statement, and this comes off of the, again, the income statement. And again, you could go through these numbers, and you can see the operating profit has gone slightly down. All right, so here's the operating profit. And you can look at these on the common size income statement, okay? All right, and then the net profit margin now, again, is the earnings available for common stockholders, which is the very, very bottom of the income statement, the last line, divided by the sales, which is the first line. So we find that the net profit margin is gone down slightly from 2015. It's almost the same, but it's slightly lower. So does this surprise you that Whole Foods makes just a little more than 3 cents of net profit for each dollar of groceries? You can see they have very thin margin. So you can see what they say here. The grocery industry notoriously has thin net profit margins. Okay. All right, so that's pretty much it. All right, so I'll save this and then we'll move on to others. I'm about 18 minutes or so into this.